Here we go. Hey, everybody, this is Rob Keens of goldsilverpros.com. I'm here with a very special guest, Chris Marchese, co-founder and chief mining analyst of Gold Seeker, as well as a lead mining analyst for both Gold Seek and Silver Seek. Chris, how are you doing today?
I'm doing pretty good. Rob, how are you?
I'm doing well. I want to jump right into it because you and I have talked quite a bit. We've been on Arcadia Economics quite a bit and had private conversations about the economy, about precious metals. And we were chatting right before the program and you were mentioning inflation, the PPI number. So let's get started there. What are we seeing in this inflation? Is this transitory or is this something that people have to watch out for? Is it going to be here to stay?
So inflation's, it's tricky. It's not going to just continue up unless they continue to print more money. Mm-hmm. It goes up and down quite a bit depending on the velocity and how much money is actually in circulation as opposed to assets and CDs and things like that. But, you know, I wouldn't be surprised if year-over-year inflation dropped in the month of June to, let's say, 3 to 4%. And, you know, we were at 5% in May. And we could even drop lower than that, and then we could rise, you know, in August or September to 6 or 7% year over year. It's not going to be a straight line or that consistent, especially when you get into these higher levels. And given all the massaging the government does, including hedonics, substitutions, geometric weighting, things like that, you know, they're going to change it up if it gets too high. Mm-hmm. As you know, they do every so often, and you know, so that's kind of what I'm looking at. But it's not transitory. It's here. I mean, there was inflation after 2008 with that bailout, but it all went into asset prices. Mm-hmm. Now we're finally seeing that go into consumer prices after basically helicopter money all of last year mm-hmm. and some of this year. Plus, we got, you know, the Fed's basically monetizing most of our deficit spending, that's inflationary if foreigners are buying the debt, not so much. So it'll be interesting times ahead, to say the least.
Yeah, I think it will too. And I'm going to share a screen on what we're talking about in terms of money supply. Make sure I get the right one here. Here is from the Fed's economic database. We have this little, you know, inconsequential event here. I don't know what everybody's so worried about when you have a vertical line. That can't possibly be damaging, can it, Chris?
Well, see, no, yeah, of course it is. But I mean, I don't like the M1 money stock. I'm an Austrian trained economist, if you want to say that. And they use the TMS, which you have to put together yourself. But I would say the next closest is M2, and they've discontinued publication of that.
Well, of course they did. Didn't they discontinue M3 a few years ago?
Yeah, M3 and M2. I mean, basically, didn't Powell say, oh, the money supply has nothing to do with inflation? I mean, that's what he said, I think, a couple months ago. So that's why I think that was a rationale behind getting rid of M2. It's insane, but, you know, people are buying into it. There was no complaints. And that's a big problem. There's so much complacency with the markets. They don't demand anything. I don't think they really understand inflation, how damaging that is, especially to the middle and lower classes.
That's right.
So, you know, it's a shame, but, you know, I think Ryan McMakin at the Mises Institute publishes the monthly TMS numbers. So you can always go up there, Mises.org, and look it up there. They do all the calculations for you. Otherwise, it's kind of a pain.
Yeah, they used to have on their website an interactive tool where you could actually pull a graph out, because I used to write articles for Seeking Alpha where I would actually pull out the TMS and I would compare it to M1, M2. In fact, I think in 2011, I did this big 6-part series on statistics in the economy, because in my book in 2009, I'd written 50 pages, chapter 2, on how they were all bunk. All the government numbers were bunk. And then 2011, I followed it up with a series of 6 articles on Seeking Alpha. And I pulled the inflation numbers. I pulled John Williams shadow stats. I pulled the official numbers, the CPI and the PCE. Because of course you got to have two in the government. You can't just have one. You need to have two to further confuse things. And then of course you have the regular and the core to further confuse things. And I was comparing the numbers, and it's funny, the Austrian true money supply was almost identical or very close to John Williams' shadow stats. And
Yeah.
I think what that illustrates is when you look at the government numbers, they don't tell the truth, and that's the big thing.
Yeah, it's very disheartening to know that, you're being lied to, unless you don't know that, of course, which most people don't. But, last year was interesting because usually the TMS and M2 aren't that correlated, but last year they were.
Yeah.
But I mean, maybe that's why they got rid of it. I don't know. M2 showing a lot of inflation. I think it was up about 30% year over year, taking out seasonal adjustments. And now, we're seeing that in consumer prices. Now I know my standard cost of living to maintain the same standard of living has gone up.
Of course.
Very significantly.
We have been talking the last few months. We've been previewing it, and I wrote in my Golden Quarterly newsletter for our website subs, we're going to see inflation this year. And I called it earlier this year because we've been following the commodities index. It's the broad ones, the Dow Jones and the Bloomberg. And you could see there, and Zero Hedge did an article on this too, the original base effect of you shut down the economy and you restart it, you're going to get really rampant inflation, first of all, because you're literally trying to restart an economy, and you're going to get, and with all that money printed that we showed a few minutes ago with the M1, you're going to get rising prices. But they shot through prior to the quote unquote pandemic, and they shot all the way back through 2016 numbers. And so it had basically obliterated a 5-year trend. And I said, okay, we've now, the commodities are up 5 years after the restart of the economy. And so we predicted inflation. And I think we're seeing that in the CPI, even though the CPI, I think, is a bunk statistic. And you also mentioned the producer price index. Maybe you can talk about that a little bit.
Yeah. So, I mean, this is a little abstract because it's not that accurate. That's partly due to how the CPI and PPI are calculated. They're not that consistent. Generally speaking, that PPI will lead the CPI, which makes sense because if producers' input costs go up, they're going to try to pass it on, and they usually have to. Otherwise, their margins get squeezed. And it would be unsustainable, especially if producer prices keep rising. So I think we got a print today, May year over year. I think it was at 6.6%. And what was it last week? I think we got the CPI number at 5% year over year. And the PPI was also elevated for the month of April. So, I guess you could draw a correlation, although it's not that strong. It's not as strong as it is in reality, in the government statistics. But, that's a big issue. And then you hear a lot of grocery store CEOs came out, I think, last week and said they're going to have to raise prices because their input costs, the costs of producing or purchasing their wholesale goods are going up very significantly.
Yeah.
And, we're seeing that in most parts of the economy. Housing, lumber prices, that could be a one-off. But when you see everything in tandem, that's part of the reason why I don't think there's any way this is transitory.
I agree.
Although, it could cool off for a while, like I said.
Yeah, if the economy cools off or something like that, it could. But as long as we continue to have these higher input prices, from commodity prices to, I would say, start with the raw commodity prices, then look at the PPI, the producers' prices, and then that should, in some way provide us an outlook for what the CPI is going to be. Or if you don't want the CPI, you can use John Williams' numbers as shadow stats.
Yeah, and I would advise the latter.
Yeah.
Or take the CPI and multiply it by 3.
Yeah.
Maybe that'll give you a better figure.
So you cover both gold and silver, specifically the mining stocks, but you also cover gold and silver for Gold Seek and Silver Seek. So why aren't we just seeing this explosion in gold and silver prices right now, given that we've had broad inflation across commodities and consumer prices? Everything costs more. Why aren't the metals reflecting that?
I think it's a couple of reasons. And the first one's not new. This goes back ever since gold and silver were used as money, and that's government debasement or manipulation in this case. And the Fed's basically a cartelization device for the commercial banks. They, open market operations. They can determine how much banks lend, not lend, that type of thing. And people don't think of it this way, but I view commercial or big money center banks that are part of the Federal Reserve System as basically agents of the government. Who got the largest bailouts in 2008? It just follows. But and then another reason is, this doesn't make sense either, but it's one of the only ones I could think of is, so the market still thinks that the Fed will be able to step in if inflation gets too hot by raising interest rates, the Fed funds rate, and therefore, the whole yield curve, and then just fend off inflation like we did in 1980 during the Volcker era. But there's so many structural issues with the economy, notably how much debt we have, the fact that we don't make anything here, we import everything. Now we're reliant on deficit spending because, the old saying, once the government, approves a policy, it's almost impossible to get rid of, especially when it comes to spending. So I think that could be part of the reason that market's still not entirely convinced. And I haven't been checking lately about how buying is going on in India and China. That's a large determinant. But mostly I think it's, the paper markets that's distorting things. It's hard to see not to. It's amazing how much the value of the silver contracts being held short relative to market size. It makes no sense. It's a massive market if you look at it by the notional value of all the contracts traded every day.
Mm-hmm.
Then you got people like Jeff Christian trying to make a weak argument that it's not manipulated. And if it wasn't, then he wouldn't need to try to defend the fact that it isn't manipulated. You could just say, now this is just market forces. And he gets so irritated doing it. So, it's funny to watch, but something's up. Those are, I think, the two biggest reasons, but, I could be wrong.
Yeah. So give us your opinion on the mining stocks right now. And before you do, I talked to Kai Hoffman of Sora Financial, who does a Canadian junior mining stock index, not just gold and silver, but across the spectrum of the junior miners. And he does like a monthly print of that index, and it usually at PDAC or somewhere, he'll do like a whole yearly view of it. So I follow him on orinc.com, which is one of his websites, for those of you who are interested. In the investment into the mining sector hasn't recovered to 2011 levels. It's fluctuated up and down. Sometimes it's looked positive, sometimes it's looked anemic. From your perspective as a mining stock analyst, do you see those inflows? Do you see a lot of positive movement back into the mining stocks, or do you think we still have a long way to go?
I do. I think gold will need to resume its uptrend. If we just look back to 2016 and we take the XAU or the HUI or the GDX and we compare it to the gold price, if you applied those to current prices, we would be probably 50 to 100% higher. Mm-hmm. Just to add on to that. So I contributed a chapter to this year's In Gold We Trust report, and I covered mining stocks and, the gross undervaluation. And I went through, senior, mid-tier, junior producers, development companies, anything with a basic technical report, at least a PEA. And I found that according to the HUI, relative to the gold price, or relative to cash flow, and price to net asset value, we're trading a full standard deviation below the 23-year historical mean. Go up, basically, they could double and still not be expensive. and still be, I mean, just a little bit below their average. And if you look at it on a price to net asset value, it's even worse than that, especially the mid-tier. So I would say the mid-tier producers are probably the best value in terms of risk reward, assuming you think senior producers are less risky than junior producers. So anyway, that's just some tidbits from the report, which is excellent. Ron Stoffel does a excellent job, and I think it's recommended reading for all just precious metal investors, not just gold. Anyway, so that was the conclusions I got from that. And since I wrote that, the gold price has gone up about $200. Mining stocks have gone up a lot as well, but not to the same degree that it should have. I mean, generally speaking, in bull markets, you get 2 to 4 times the movement in mining stocks than you do in the underlying gold price or silver price due to margin expansion. So yes, I would agree they're grossly undervalued, but will they come back to normalcy? I think so. I think they'll be properly valued at some point, especially when the next up leg begins and we break. I think it'll be 1950 gold, 2000, somewhere around there, and silver 30. They'll be off to the moon. But however, the silver stocks are actually pretty fairly valued. They're not outrageous like the gold stocks, which is, I mean, it could be because there's so few primary silver producers, and I just mean at least 50% of total revenue derived from silver. It doesn't have to be 70 or 80%, but that could and likely is a reason. But yeah, it's amazing. It's a great value. If you buy quality companies, you could buy them at relative discounts. So, I think everyone should have a little exposure. If you don't want to, if you think it's too risky, go with the large royalty and streaming companies. Franco-Nevada, for example, provide you leverage. It won't perform anywhere close to the others, but if you look at the 10-year chart, they're able to create value during the down years. And the stock price, it's basically continued straight up, slowly but surely over before and during the last bear market.
Yeah, we have been recommending some royalty companies. We did a uranium company. We also did Sailfish Royalty, which is one of our program sponsors, in terms of getting into the gold space, because it's a good way to gain leverage without as much of the actual mining operations risk that you get when you go into individual miners. But the upside with the miners is when you hit on one, it can really change your portfolio, and it doesn't take hitting on a bunch. So real quick, last question I want to ask you from like a portfolio allocation or structuring perspective. Do you have recommendations for people on how to allocate your portfolio to like majors, mid-tiers, royalty companies? Are there any rules of thumb that you can provide?
So, I mean, there's a lot of subjectivity that goes into this because it's all based on your risk reward. I mean, if you're an average investor, it doesn't know much, but is trying to learn about the sector. Maybe you follow 1 or 2 newsletter guys. My recommendation would be start with the royalty and streaming companies. Get 2 or 3 of those, just as core positions that you'll want to hold through the entirety of the cycle, because their revenue base is so diverse that if something happens to one asset for a while, it's not a big deal. Whereas, if you got a junior, even mid-tier company with a large enough mine, and something happens to that, the share price will get pummeled very quickly. And then aside from that, junior exploration, that should just be money you can afford to lose. So it's not a huge deal. You're not gonna, you'll be able to sleep at night knowing that if you lost all that when you woke up, you'd be okay. And you could put 1.5% of your gold or silver portfolio into junior exploration, and if you hit one, I mean, they could become 8 to 10% very quickly. One example, like we run a a premium service for our subscribers where we run an actively managed portfolio. It's not aimed at total return. It's like we'll have 20% in royalty companies, 15% in senior producers, down the list to mid-tier through exploration. And so we start with high quality and sizable positions, but or large caps, sorry. But when I don't know how would I say this. Let's move on from that. But getting too intricate with the specifics.
Well, if people want to know more about what you write about, information that you provide, how do they go about reaching you?
Well, you can email me, chris@goldseek.com. You can follow me on Twitter at CJMAUAG. And I think that's about it. Or direct message me on Twitter. You can also sign up for a free newsletter at goldseeker.com or goldseek or silverseek.com.
Okay.
I do a weekly article on Goldseek, and it just basically recaps some important mining news every week. It usually covers, 10 to 20 companies. If they put out excellent drill results or decent drill results, report, earnings or, release of technical reports, that kind of thing.
Okay. Fantastic. Thank you so much, Chris, for having me on the program. I know there's a lot more that we want to talk about, a lot of things that we didn't even touch on in this one, but I want to have you back on the program for that. But appreciate your advice in terms of the mining stocks. I know that you're an expert on that for several different publications, and I know a lot of our audience would really appreciate that. They're avid investors in that space. So thank you so much for joining the program. Thanks
for having me on, Rob.
Hey guys, if you like the research that you just saw in the previous video, I'd like to invite you to join our research intelligence team. This is a group of individuals who do research for us and submit it to us so that we can have it on the air. We'll keep you anonymous, but we'd like to leverage all of your talents in providing us information. Many of you have emailed me in the past, but I just get flooded with emails and don't have time to go through them all. But if you have links to information about the things that we like to talk about on the channel, we would like to see your contributions and incorporate it into our research. So please click on the Google Forms doc below, sign up for that. We'll get you added to the research team and get you a place where you can drop that information. And we will look forward to your contributions and appreciate you guys supporting the channel. Thank you so much.